Most people get rich by doing almost nothing for decades. Warren Buffett has shown us this truth. Year after year, his investment philosophy boils down to a few core ideas that truly work for him. One key lesson is to think like a business owner, not a stock trader. You are buying a piece of a company, not just a ticker symbol. This means you must understand the business you are investing in, what it does, how it makes money, and who its competitors are. He calls this operating within your circle of competence. If you do not understand a business, then you should not invest. This stops wild guesses or following fads. Another powerful insight is the concept of a moat. This is a sustainable competitive advantage a business has. Think of a castle with a deep, wide moat protecting it from invaders. For a business, this could be a strong brand like Coca-Cola, a patent on a unique product, or a cost advantage allowing it to sell at lower prices. Companies with wide moats protect their earnings for many years. They are harder for new companies to compete against. Buffett often buys businesses whole for Berkshire Hathaway, a conglomerate he built from textile beginnings. For individual investors, buying shares of these moat companies works too. He looks for these advantages because he plans to hold stocks for a very long time, not just for months or even a few years. The idea of long-term investing, it is not just a phrase for him. It is a fundamental strategy. He famously said his favorite holding period is forever. This allows compounding to work its magic. Compounding means your investments earn returns, and then those returns also start earning returns. It is like a snowball rolling downhill, gathering more snow, getting bigger. Over decades, this turns a modest sum into a fortune. For instance, $10,000 earning 10% per year would become over $107,000 in 25 years. If you hold it for 50 years, it would be more than $1.1 million. Patience is a massive part of this. You need to let time do the heavy lifting, resisting daily or weekly portfolio checks. That constant checking leads to irrational decisions. Many investors get caught in market fluctuations. They buy when stocks are high and sell when low, driven by emotion. This is the opposite of what Buffett advises. He believes in being greedy when others are fearful and fearful when others are greedy. This means buying good companies when their stock prices are temporarily depressed. When the market is in a panic, that is often the best time to buy. This gives you a margin of safety. You are buying $1 worth of assets for maybe 50 cents. This protects your downside. It also provides significant upside potential when the market recovers. He did this during the 1974 downturn and again during the 2008 financial crisis. These periods of widespread fear presented incredible opportunities for those with cash. Another important lesson is about the importance of cash. Having decent cash on hand is not just for personal emergencies. For Buffett, it is dry powder. It is ready capital to deploy when rare opportunities arise. If you are fully invested all the time, you cannot take advantage of market crashes without selling existing holdings, possibly at a loss. He keeps tens of billions of dollars in cash at Berkshire Hathaway for just such moments, waiting for the fat pitch. This strategy allows him to be a buyer of last resort for some companies, or to snatch up valuable assets when everyone else sells everything in a panic. It is about preparedness and discipline. Education is also a huge part of his success. He spends a significant portion of his day reading annual reports, industry journals, and economic data. He devours information, often dedicating 5 to 6 hours daily. He believes the more you read and learn, the better investor you will become. It helps him expand his circle of competence and identify potential moats. He often speaks about continuous learning and intellectual curiosity. It is not about a fancy degree. It is about constantly absorbing new knowledge and thinking critically. Avoiding debt is another major principle. He advises against using debt to invest, especially in the stock market. Leverage can magnify gains, but also losses significantly. When the market goes down, debt can force you to sell investments at the worst time, usually to meet margin calls. It can wipe you out completely. He prefers a conservative balance sheet, both for himself and for Berkshire Hathaway. This financial prudence provides stability. It allows him to weather any economic storm without external pressure. He understands that certainty and safety are more valuable than aggressive speculation. His own personal journey reflects these principles from an early age. He started investing young, buying his first stock at age 11. He bought 3 shares of City Service Preferred for $38.25 each. He sold them for a small profit after they went up to $40, only to watch them shoot up to $200. This taught him an early lesson about patience and not selling too soon when a good company still has potential. He then bought a pinball machine for $25 and placed it in a barbershop. He expanded this small business into multiple machines, eventually selling it for $1,200. Showing his entrepreneurial spirit even then before his investment career blossomed, Berkshire Hathaway itself started as a struggling textile company, a declining business in the United States. Buffett took it over, slowly transitioning it away from textiles. He poured capital into insurance and other diversified businesses, building a strong foundation. This transformation took many years, significant capital allocation, skill, and strategic vision. Today, it owns hundreds of different companies, from insurance giants like Geico and BNSF, a major railroad company to energy utilities like Pacificorp, and iconic brands like See's Candies and Dairy Queen. Its market value is hundreds of billions of dollars. It employs hundreds of thousands of people globally across its subsidiaries. His track record is almost unmatched globally, an average annual return of over 20% for over 50 years. This consistent performance made him one of the wealthiest individuals on the planet. His net worth is often over $100 billion, a testament to his simple yet profound strategies. Imagine that kind of wealth accumulated from essentially following a few simple common sense rules that anyone can understand. He makes investing sound easy, but it requires immense discipline and a strong temperament to stick with those rules through thick and thin. Not everyone can sit through market downturns without panicking. Not everyone can resist chasing the latest hot stock or participating in speculative bubbles. His emphasis on value means finding companies trading below their true intrinsic worth. He calculates this intrinsic value based on a company's future earnings power and asset values. It is not about fancy mathematical models. It is about understanding the underlying business and its long-term cash flow generation capabilities. He prefers businesses that are easy to understand and consistently profitable. He also stresses the importance of good management. He likes to invest in companies run by honest, capable managers who are rational thinkers, people who treat shareholder money as if it were their own. He often gives much autonomy to managers of companies Berkshire Hathaway acquires, trusting them to run their businesses effectively without constant interference. This hands-off approach allows managers to focus on long-term growth and operational excellence rather than being distracted by short-term quarterly results. It is a partnership approach built on trust and shared long-term vision. His advice is timeless. It applies to individuals just starting out, and to seasoned professionals, the principles are simple, but not always easy to execute in the face of market volatility and human emotion. It requires emotional control and a long-term perspective that often goes against conventional wisdom. He has consistently shown that a patient approach, focused on quality businesses, purchased at reasonable prices, can lead to extraordinary wealth accumulation over a lifetime. His teachings have certainly changed how millions of people think about making money and building lasting prosperity through sound investment choices. It is a testament to the power of fundamental investing over speculation and excessive market noise.